Welcome back. How do you know whether to buy down your rate when you're buying a house or to take advantage of a 2-1 buy down? We're kind of seeing this market in which rates are staying higher for longer. So we thought this would be a good video to make, and also had a couple of comments about this as well. And of course, I'm joined by Jim Black, the man, the myth, the legend. Welcome back, Jim.
How's it going, Jason? I've gotten older. I got glasses now, and I've aged since our last video. So we look similar now. Just teasing.
I know, we do. We do. Same age. Now we both have glasses. Yeah.
What's happening to us?
Yeah, right. It's been a while since I had you on the channel, but I mean, you're like a wealth of knowledge on the lending side. You've been a loan officer for like 22 years, and of course, a dear friend of mine as well. So yeah, I think there's this question I've been getting on the channel, like there was this expectation that rates were going to decrease to the 5s by now, and of course, we're in the upper 6s, 7% range right now. And there's also this expectation that we're going to be at a higher rate environment, around 6% next year. So how can people buy houses using a lower rate? And so I want to talk about buying down your rate or doing a 2-1 buy down and how that works. So
absolutely, yeah. So again, the days of marrying the house and divorcing the rate, right now, divorces are on pause for a little while. So you can't get rid of that expression that they've talked about for a lot of years. Around that. And when we look at rates right now, we always look at the payment comfort for a client of ours and also what's their long-term plan. And what factors into that is the costs to get to the long-term plan. So when we look at interest rates, we always ask the question to our client or borrower, what do you think is going to happen with interest rates? What do you think is going to happen in the economy? Because we want them to be collaborative in the process of making sure they're making the right decision with all the solutions that we have available. So like you mentioned, there are two approaches to buying the rate down lower. One is a longer term fixed on the entire term of the loan, which is known as a buy down in points. And the other one is known as a seller 2-1 buy down. These are both for purchase minded strategies. On a seller 2-1 buy down, the seller is paying the costs. On the buyer down for the regular long term loan, the consumer is normally paying that, or maybe a credit from the seller. So know that there are two strategies there. It all comes down to the timing you think it will take to either A, to have the rate go lower, B, maybe buy or sell the property and move again, or C, if you think rates are going higher, you may want to have that longer term strategy of buying the rate down as low as possible.
Yeah. So the buy down you're saying is something that the buyer typically would pay unless they get a closing cost credit from the seller, of course, right? Yes. And that's to buy down your rate over the life of the loan. A lot of people get your fix, right? Versus a 2-1 buy down is a short-term option in which it decreases rates for only 2 years. Down 2% in the first year, down 1% in the second year, and becomes whatever the market rate is in year 3 through 30.
Let's show an example. Let's show an example right now at a $500,000 loan amount size. So can you guys see my screens okay, hopefully?
Yep, we can see your screen just fine.
Fantastic. So on this screen, you're going to see what's known as a 2-1 temporary buy down. The years are year 2 and year 1 have a discount or a reward for our borrower. The remaining term remains at the exact same rate that they started with. So in this example, we have a $500,000 loan with a fixed rate of 6.5% for 30 years. You'll notice that in year 1, there's a 4.5% rate. Compared to the original payment of $3,160, the new payment saves roughly $626 a month, which is annualized at about $7,500 of additional savings. Year 2, the rate goes up to 5.5%, or 1% lower than the fixed rate, and that gives us a savings of about $321, or roughly about half the difference in savings. You'll see that the combined savings for both years is the number on the bottom right-hand corner. $11,379.60 are the actual savings that are done over the life of that 2-year period of time. That payment then goes for the next 28 years, or till you refinance, to that original $3,160 a month payment. So the seller gives a credit in this example of the total combined subsidy of $11,379.60. That's what they give. That's the credit that we ask the seller to pay for to buy this rate lower. So far with me there, Jason?
Yeah, absolutely. So that's equates to 2.28% of the loan amount, which is $500,000.
Yep,
So
exactly.
let's kind of like walk this through. So obviously this would not work probably in an area that has a lack of houses for sale, an area that's getting multiple offers, for example. But it really would work in an area in which buyers have an advantage over home sellers, and sellers just want to get their house sold. So therefore, they're more willing to negotiate with a buyer. So in this example here, let's just say you're buying a house for whatever, $600,000. Your loan amount is $500,000. It's going to cost $11,379 to do a 2-1 buy down. As you write up your offer with your real estate agent, you ask the seller to give you that money as a closing cost credit. In other words, it decreases your, or actually allows you to get this 2-1 buy down loan product. Correct,
Yep,
Jim?
you got it right. And ironically, it's not also uncommon right now to have the seller increase the price by the same subsidy amount. So let's say I was buying a house for $500,000 and I needed a $12,000 credit. I may go to the seller and present an offer of $512,000 and get a $12,000 credit. The only big thing that we need to be aware of is that the value of the property needs to be there in that approach, because we are inflating or adjusting higher the price of the home to get a credit. There is a small disadvantage to the borrower also, where they'll be paying property taxes based on the smaller increase versus what they would have paid. So that's a very good way of doing it. It gives people a little more cash consciousness during the first few months of moving. Maybe they got to buy furniture or paint a house or whatever it might be. That's why we like to look at both those approaches in both a buyer's market and a seller's market.
Absolutely. And so we're just going to do a quick little calculation here. So in California, our average property taxes is about 1.25%. So you're only adding $150 per year in additional property taxes if you're going to offer $512,000 versus $500,000. So it nets the seller the same, right? A $512,000 offer asking for a $12,000 credit is exactly the same for the seller if you're writing an offer for $500,000. You're netting $500,000. But for the buyer, like Jim mentioned, the main concern there is appraisal. If you're pushing the envelope where your offer amount is very close to what you feel the house would appraise for, then it could be a kind of a not a good scenario, because of course the house has to appraise for your purchase price or offer amount. So just something to take in consideration.
Absolutely. And again, every market's unique and different. So work with your best local professionals. There's another whole thing around this too. There is a seller and a lender ability to do a buy down. So in some examples, I can actually give a lender credit to do a buy down. What that strategy only works really well for is people believing that rates are going lower in the next 2 years, because it does not make sense to have a lower starting or higher starting rate, because I'll use subsidy or rebate to then have that rate be higher after 2 years. It wouldn't make it sense at all to do that. So that's important to think about. Each situation, each scenario is different. Talk to the pros, get a couple options, and make the choice that's best for your needs.
Yeah, well said. And I think the good thing about this is that the buyer doesn't have to pay for it. If you have to write an offer over the asking price and inflate it by this amount, I mean, just like my example, you're going to be paying only $150 per year, but you're going to be saving $11,400 over the past 2 years, right? So it really would make sense in a market that's really not very competitive that you can ask the seller for this credit. Let's also talk. Anything more you want to add regarding that?
There's one more thing. Let's say miraculously, in this example, rates are at 6.5%. Let's say rates drop to 5.5%, and I just finished my year one of my savings. Well, do I get the rest of my savings? What happens to the rest of the money that's owed to me in year two? I should have a difference of $3,856 still. Well, what's really cool about this product is there's a principal reduction that would go on your payoff for that difference. Whatever is owed to you is still your money that is taking off the principal balance. So you don't lose this benefit if rates drop all of a sudden. There is no prepayment penalty on any loans that we do. So hopefully rates do go lower. Hopefully you're buying and using this to help you with cash flow temporarily, and then have the grace of possibly rates dropping to help you out with that too.
So if you refinance right after year one, you have an additional savings that you have not used of $3,856. You're saying that if you refinance, then you can reduce that amount by your loan balance when you're refinancing?
That's correct. Pretty cool. So you're getting the benefit no matter what happens. Even if you sell the property, you're still getting that benefit. Pretty cool.
Oh, even if you sell it too. Okay, yeah. And on top of that, the seller is paying for it originally, so you can get recoup those savings that you didn't have to pay for, which is really cool.
Exactly. Yep.
Okay.
And
awesome.
if there's any additional credit you're getting, let's say in this example, we know we needed about $11,400. Let's say you got a credit for $20,000 total, and you had a remaining balance of like 90 or 8,500 bucks left to use. You can use credit for non-reoccurring items. Non-recurring items or one-time items are insurance, any HOA fees that are collected up front, any transactional costs, title, appraisal, escrow, lender, or credit reports, and it can be used for impounds. Impounds are putting your property taxes and insurance into a payment. Normally, when you have an impound account, it's about a 6 month of collection up front of your property taxes for the year and a year of your insurance. So it's a really good way to get the most credit you can to be able to offset all those extra expenses that you might not be used to as a move up or first time home buyer.
Okay, so you're saying you can either reduce your loan balance when you're refinancing, or if you're selling to, you can use those to decrease your closing costs, basically.
Yep, which is really cool. Yeah,
that's really awesome. Okay, really awesome. Okay, let's talk about this option, of course, but also buying down your rate, which is paying points over the life of the loan there. So let's talk about that as well.
Yeah, let's do that. So we don't need a screen for that. We can just explain the theory of that. So when we buy down a permanent buy down, permanent versus temporary buy down, you're buying down the rate from day one till the end of the term. The most you can buy down the rate legally in high cost areas, which is anywhere you're doing a regular loan, is a total of 3 points of costs in a transaction. So that means you can't spend extra money more than 3% of the loan itself in any transactional costs. So if someone's offering you 8 points buy down and it's an owner occupied or conventional loan, can't be done. It's a red flag. So we want to make sure that the break even on this stuff also makes sense. For example, if I was going to spend $10,000 and save $1,000 a month, my break even is 10 months. That's a really good decision for the next potentially 29 years and 2 months. I'm saving $1,000 more and will have already absorbed the cost of that within the first year. Mm-hmm. If I take that same example and say it cost me $10,000 to save $100 a month, we know that break even is in 100 months, which is roughly about 8 years. That's not worth it in my example or in my experience, because rates tend to have seasonality every 3 to 4 years, where if you're in a cycle, you're going to hit the bottom or high of that cycle within that period of time. So that's not worth spending money to do unless you feel like we're going to be in double-digit rates forever, which is very unlikely with all the economic news and trends and history of our economy. So.
Yeah, so right, it wouldn't make sense to have a break even so far out, because one would assume that rates will decrease compared to the rate you had when you bought the house, and therefore you can just refinance, right?
Exactly. And everyone tends to move. There's some new stats that came out. Everyone tends to move every 13 to 14 years is the average right now. So again, you're not going to have, to me, make sure it's a short-term benefit trade-off, not wait too long down the road. Because life happens. You're going to move unexpectedly probably, or get a promotion, or have kids, or kids go away to college, or empty nester, you retire, divorce, death, all those life events that happen. You just can't predict today in this world you're going to live in a house for 30 years. Yeah,
absolutely. Yeah, it's interesting. That stat used to be 10 years for so long. And I think that's going to get extended because of all the run up in appreciation, of course, lower rates that people have. How do you, what's your advice for people? Like what should be your break even? Should be 1 year, 2 years? What's your advice?
I like to look at about 2.5 years. So about 30 months, for whatever reason, that's what I look at it as. Because in 30 months, you're going to see market changes, hopefully better in all categories, hopefully more appreciation, hopefully lower rates, hopefully a better job, hopefully more income, and lower expenses. So I look at that as kind of the trade-off.
Okay.
If you're saving,
go ahead.
If you're saving money day one, you've been at a way too high of an interest rate for way too long. That's what that means to me. So I like to try to do this one time correctly. I don't like to churn loans. There are people in our industry that churn loans. It's a really frowned upon activity. So if I can do my job great one time and get the best outcome and not have to touch a loan again for everyone's sake, our clients save money. It's less worry that they didn't get the best situation to be in, and it's a process to go through. It's not just fog and mirror. You got to provide documents and sometimes get an appraisal and sign documents, and those things can sometimes weigh on people if they're busy.
Oh, for sure. Yeah. I mean, it's like going through an audit nowadays, whereas like 2008, it was just like,
yeah,
anyone can get a loan approved. It's absolutely wild. Okay. And then can you we'll kind of hop off here, but in general, can you kind of explain like a example of someone who is buying down the rate by 1 or 2%, what that looks like, and then we'll kind of wrap this video up.
Yeah. So on my end, when you buy a rate down, if you pay a point, it's probably equivalent to about 3/8 in rate, 0.375 in rate. Sometimes there's not a benefit to buy the rate lower. Sometimes paying 1 point only gets you up an 1/8 or down an 1/8 in rate. That would not be worth doing. I believe you got to save at least 3/8, 0.375 or more in rate savings to make it worthwhile.
Got it.
Because sometimes points can be deductible. Sometimes they can't. Talk to your CPA about that. Everyone's financial situation is different. But I look at it and I say to myself, if I'm going to do something, A, it's for the long run. B, do I have a net tangible benefit, or is there a benefit in the short horizon to make this work? And that extra savings I'm going to have, what can I do with that and apply to maybe pay off other debt or maybe pay off this loan faster? Those are all positive things when rates go lower. And I always like to make sure we dive in deep to make sure we're meeting the objectives of that specific situation.
Got it. Makes sense. Okay, cool. Well, thanks, Jim, for your insights. We're going to make a separate video, by the way, because Jim just got licensed in multiple states, not just California, where we live, of course. So we'll make a separate video regarding that. But Jim, thank you so much for joining us in today's video. We appreciate you.
Thanks, Jason. Appreciate you leading the way. And please, we'll look forward to the next call with you. Thank you so much.
Absolutely. Yeah. And then we'll provide a link in the video description below if you guys want to schedule a call with us. We do free consultations for anyone living in the United States. And of course, we have a link below as well for people who do want to apply for a loan as well. But before you do that, please email me at jason@meetjasonwalter.com. And I'll give you guys some insights whether or not Jim is licensed in the state that you want to refinance or purchase. But thank you everyone for watching today's video. Please like and subscribe. And of course, please follow Jim Black on social media as well. Hope you guys have an amazing day. We'll see you next video.